company can look like a wall of intimidating numbers. Hundreds of figures in a report nobody wants to read. But a seasoned value investor does not drown in all of them. They glance at a tiny handful, 5 numbers really, and within a minute they have a rough sense of whether a business is cheap, healthy, profitable, and worth a closer look. Today, you get those exact 5 numbers. Learn them, and you can size up almost any company faster than you can order coffee. A quick promise before we start. None of these 5 is magic on its own. Each is one window into the house. But look through all 5 together, and the whole shape of the company appears. So let's collect your 5 windows, one at a time. Number 1, the famous one, the P/E ratio. Price to earnings. You already met it. You take the share price and divide it by the earnings per share, and you get how many years of current profit you are paying for one share. Is your first read on a single question. Is this stock cheap or expensive? A low P/E can mean a bargain or a troubled company. A high P/E means the market expects a lot of growth. It is not a verdict. It is a starting question, and it is always the first number a value investor glances at. Number 2, the quiet favorite of Benjamin Graham himself, the P/B ratio. Price to book. Now, book value is simply the company's net worth on paper, everything it owns minus everything it owes, the equity from the balance sheet. The P/B compares the company's price to that net worth. If the P/B is below 1, you are, in theory, paying less than the company's assets are worth on paper. Graham hunted for exactly these situations, solid companies trading for less than the stuff inside them. P/B is especially useful for banks and asset-heavy businesses, and less meaningful for a software company whose value lives in ideas, not buildings. Number 3 is the health check, and ignoring it has bankrupted many a confident investor. The debt-to-equity ratio. This simply compares how much a company owes to how much truly belongs to its shareholders. A low number means the company stands mostly on its own money, sturdy and hard to topple. A high number means it leans heavily on borrowed money, which is fine in sunshine and deadly in a storm. When you check debt to equity, you are really asking one survival question. If business got bad for 2 years, would this company make it, or would the debt crush it? Number 4 is the one Warren Buffett reportedly loves most, the quality number, return on equity, or ROE. This measures how much profit a company squeezes out of the shareholders' money. Picture 2 companies, each given $100 by their owners. One turns it into $20 of profit a year. The other turns it into 3. The first has a far higher return on equity, and it is, in a real sense, a better business, a more efficient money-making machine. Buffett famously hunts for companies with high and consistent ROE year after year, because that steadiness is the fingerprint of a genuine, durable advantage. Number 5 is the one that can quietly pay you while you wait, the dividend yield. Many companies hand a slice of their profits back to shareholders in cash, called a dividend. The dividend yield is just that annual cash payment divided by the share price, expressed as a percentage. A yield of 3% means you collect $3 a year for every 100 you invested, just for holding. Lovely. But here is the trap. A shockingly high yield, say 10 or 12%, is often not a gift but a warning, a sign the price has crashed because the market fears the dividend cannot last. In dividends, as everywhere, if it looks too good to be true, lean in and ask why. So there they are, your 5 windows. P. Is it cheap? P/B. Where its assets worth? Debt to equity. Can it survive a storm? Return on equity. Is it a high-quality machine? And dividend yield. Does it pay me to wait? Run those 5 on any company, and you go from staring at a wall of numbers to holding a quick, honest sketch of the business. Now the rule that separates the wise from the reckless, and please tattoo it on your brain. No single one of these 5 ever decides anything. A low P/E with crushing debt is a trap. A gorgeous ROE at an insane price is a trap. A juicy dividend on a dying company is a trap. The 5 numbers only tell the truth as a team, and every one of them is meaningless without context. You must compare a company to its own past and to its direct competitors, because a P/E of 15 might be cheap for one industry and wildly expensive for another. Numbers without comparison are just noise. And underneath all five sits the oldest idea in value investing, the one Benjamin Graham repeated his whole life: the margin of safety. You're not looking for a perfect company at a perfect price, because that does not exist. You're looking for a good enough business at a low enough price that even if you are somewhat wrong, you still do not get badly hurt. These five numbers are simply the fastest way to spot when that rare, sensible bargain might be sitting right in front of you. So look back at that intimidating wall of figures we started with. It has not gotten any smaller, but you no longer need most of it. You have 5 windows now, 5 quick questions, the same ones the great investors have been asking for generations. Is it cheap? What are its assets worth? Can it survive? Is it a quality machine? And does it pay you to wait? Master those, always in context, always together, and you can read a company in the time it takes most people to read its name. I'll see you in the next one. Until then, keep it simple, and remember that 5 honest numbers beat 1,000 noisy ones.